Howdy, everybody. Welcome to Liberty Call. Today is Friday, June 7th, 2024. Hope you're having a good day out there in the interwebs. It got gloomy here this afternoon here in Colorado. It was sunny and beautiful, and I go and get dressed because I'm going to go run some errands after this, and it's all overcast, windy, and it's raining. So, yay! Hope your weekend's starting out better than mine. Anyways, all right, if it is your first time watching the Liberty Call, I'm glad you're here. If you could do me a favor, give me some thumbs up, a like, a share, subscribe, a follow, and press the notification bell because I say smart things, but only once or twice a week. So you got to tune in every single day. I can't reiterate that enough. Today could be that day. I doubt it, but anyways, all right. Well, it looks like the markets, we got a good jobs report today. How much you're going to believe it, I don't know, but it's weird. Good news is bad news for the market, and bad news is good news for the market. So just a weird time right now. All right, let's go ahead and look at the indexes for today. The Dow Jones was down 0.22%, 87 points, closed at 38,798. S&P 500 was down 0.12%, 6 points, closed at 5346. NASDAQ down 0.25%, 43 points, closed at 17,129. VIX was down also 2.78% today. It's at 1273. Canada down 1% even. Brazil down 1.77%. And Mexico back in the red column, going down 2.72% today. Over in Europe, Germany was down 0.52%. The UK down 0.48%. France down also 0.48%. The Netherlands up 0.04%. Spain down 0.34%. Italy down 0.5%. Switzerland up 0.15%. And Portugal down 1.13%. Russian exchanges both back in the green today. MOEX up 1.19%. RTSI up 0.86%. And the overnights, the Nikkei was down 0.22%. Australia was up 0.49%. New Zealand down 0.79%. In China, the Shanghai was up 0.08%. The Shenzhen component down 0.9%. China 850 down 0.94%. DJ Shanghai up 0.03%. Hang Seng down 0.59%. And the Taiwan weighted when it closed on the 6th was up 1.94%. All right, so those are the markets for today. Let's go ahead and let me bring up my chart and we'll see how things did for the week. All right, starting out with the Dow Jones. Looks like it's going to finish the week off in the green, barely, by 0.86%. The S&P 500, it's going to finish the week off up about 1.93%. NASDAQ, it's going to finish the week off about 1.52% up. The Dow Utilities down 2.25%. And the Dow Transports down 0.88%. So it looks like the three major indexes finished off in the green for the week. The Dow, the NASDAQ, and the 500, but the more minor not minor, but less well-known indexes are finished off in the red for the week. So that's the week in the markets. Let's go ahead and get to the economic data that came out this week. There was quite a bit. Initial jobless claims came in at 229,000. The forecast was 220. Last week's number was 221, so we went up by 8,000 there. Continuing claims came in at 1.792 million. Forecast was 1.79, so 2,000 over forecast. Last week's number was 1.79. The ISM Manufacturing Purchasing Managers Index, the PMI, came in at 48.7. Forecast was 49.8. Last month's number was 49.2. Construction spending month over month contracted at negative 0.1%. Forecast was 0.2% growth. Last month's number was a negative 0.2%. U.S. car sales came in at 3.07 million. The previous number was 3.04, so looks like it grew a little bit. Truck sales came in at 12.84 million. Previous number was 12.74, so it looks like it grew a little bit there too. Factory orders month over month grew at 0.7%, right on forecast, and the same as last month's numbers. The ADP non-farm employment change grew at 152,000. The forecast was 173, and last month's number was 188. All right. The U.S. trade deficit came in at a deficit of $74.6 billion. Forecast was $76.2 billion, so better than forecast. And last month's number was $68.6, so a pretty sizable jump from last month's number. U.S. non-farm payrolls grew by 272,000. Forecast was only 182. Last month's number was 165. So, I mean, and you may be asking yourself, where was the previous number? Factory orders. The ADP non-farm employment change came in at 152, and non-farm payrolls came in at 272. So I don't know. I don't know where they're pulling the data from. So who knows? The unemployment rate grew to 4% from 3.9 last month. The forecast for this month was also 3.9%. So smidge over forecast. And the labor participation rate is currently at 62.5%. The last reported number was 62.7, so a little bit of a contraction there. So, all right, those are all the economic numbers that came out this week. Exciting stuff, I know. Let's go ahead and get over to the market recap. The S&P 500 shrugs off jobs data led jump in Treasury yields to hit record high and then fell back. The S&P 500 reached a new record high on Friday despite some intraday weaknesses. This was driven by stronger than expected jobs report that tempered optimism for imminent Federal Reserve rate cuts. Non-farm payrolls surged by 272,000 in May, far exceeding the anticipated 182, while average hourly earnings increased by 0.4%, surpassing the projection of 0.3%. However, the unemployment rate rose to 4%, slightly above the expected 3.9%. The robust labor market data led to a rise in Treasury yields as traders reduced their bets on a rate cut in September, with the likelihood dropping from 55 to 45%, according to Investing.com's Fed Rate Monitor tool. Scotiabank economists expects the FOMC to maintain current policy in their upcoming meeting and predicts a reduction in the number of rate cuts forecasted for the year from 3 to 2, maintaining September as the best case for the first cut. In corporate news, Samsara reported better than expected Q1 results. However, the Truist Securities expressed reservations about its valuation, suggesting that current prices do not justify new investment despite strong performance. GameStop experienced a significant 40% drop in its stock value following disappointing first quarter results and plans to issue up to 75 million more shares. Similarly, DocuSign fell 8%, despite surpassing earnings expectations for Q1 and providing inline guidance for Q2. Conversely, Lyft remained flat after announcing an expected 15% compound annual growth rate in gross bookings over the next 3 years. Overall, the strong jobs market data led to a reevaluation of Federal Reserve rate cut expectations and mixed reactions in the corporate sector, contributing to market dynamics on Friday. All right. Good stuff. Let's get over to May employment report. This is from Robert Stein, Deputy Chief Economist at First Trust Financial. All right. The U.S. jobs market remains robust, although with some imperfections. In May, non-farm payrolls increased by 272,000, significantly surpassing the expected 180. Total hours worked rose by 0.2% and are up 1.3% year over year, while average hourly earnings grew by 0.4% in May and 4.1% annually, outpacing inflation. A core measure of payrolls, excluding government, education, and health services and leisure and hospitality sectors, showed a solid rise of 101,000 jobs, marking the second fastest growth in the past year. However, there are concerning signs. Civil employment, which includes small business startups, fell by 408,000 in May, and the labor force shrank by 250,000, leading to an unemployment rate increase to 4%, the highest since January of 22. The labor force participation rate dropped to 62.5%, and the employment rate fell to 60.1%. There's speculation that a surge in immigration at the border might have driven continued payroll growth as payroll payroll survey figures often include undocumented immigrants. I call them wetbacks personally. Unlike the household survey, this aligns with data showing payrolls growing by 2.8 million over the past year compared to a 400,000 increase in civilian employment. Consequently, foreign-born workforce shares have risen 19.2%, up from 16.6% a decade ago. Alternatively, the slowdown in employment growth might signal an economic turning point towards a recession. Given these factors, it is expected that the upcoming year will see weaker economic performance compared to the recent past. Despite the strong payroll numbers, the job market's underlying issues suggest that the Federal Reserve may still find overall economic conditions too strong to warrant easing its policies. All right. So that's that. Let's dive a little deeper into, as Zero Hedge titles this, Inside the Most Ridiculous Jobs Report in Years. So see what he has to say. All right. The May jobs report from the BLS was unexpectedly strong, with 272,000 payrolls added, surpassing all major forecasts. JP Morgan and Goldman Sachs had anticipated lower figures of 150 and 165,000, respectively. Despite the high payroll number, the unemployment rate rose from 3.9 to 4%. This discrepancy arises from a divergence between Establishment Survey, which shows job gains, and the Household Survey, which shows a decline of 408,000 jobs. Economists, including Bloomberg's Anna Wong, argue that the Household Survey provides a more accurate picture. Wong attributes the inflated payroll numbers to the BLS birth-death model, which has added 1.9 million jobs since last April, accounting for over half of the reported job gains. So what they're saying here is they're using a lot of estimates and not real numbers. So take it with a grain of salt. Where was I? This model, she contends, is not accurately reflecting of the current economic reality of business closures and declining formations. Further analysis reveals troubling trends in job composition. The past year saw a loss of 1.2 million full-time jobs, offset by a rise in part-time jobs by 1.5 million. In May alone, 625,000 full-time jobs were lost, replaced by 286,000 part-time jobs. Additionally, there has been a significant shift in employment demographics, with native-born workers losing 663,000 jobs in May, while foreign-born workers gained 414,000 jobs. Over the past 4 years, job growth has exclusively benefited foreign-born workers, including many illegal immigrants. The shift between potential political implications, especially with the upcoming presidential debate between Trump and Joe Biden. The report suggests that the Biden administration's policies on immigration and economic management will come under scrutiny. No, really? It is anticipated that these issues, alongside concerns about the impending recession, will dominate the political discourse leading up to the election. Yeah, it's funny when you start seeing the people who write these articles, journalists, that's the word, these financial journalists starting to use the word recession more and the impending recession. So it's not that it may happen. And now it's more like, well, when? All right, and more good news. Also from Zero Hedge, this last article, Retail Bloodbath, more than 2,600 store closings have been announced so far in 2024. This was written by Michael Snyder of the Economic Collapse blog. So let's see what Mr. Snyder has to say. Retail stores in the United States are closing at an alarming rate, with the total number of closures in 2024 projected to be nearly 40% higher than in 2023, indicating a significant economic crisis. More retailers like Macy's, Walmart, Walgreens, and Foot Locker, along with discount stores and drugstores, have announced nearly 2,600 closures in the first 4 months of the year. If this trend continues, approximately 7,800 store closings will be reported by year end. But again, that's assuming that everything is constant on a it just goes on a straight line. Real life doesn't work like that. Several factors contribute to this surge in closures. Economic conditions are deteriorating, leading to a decline in consumer spending. Although I have not seen that in the consumer spending chart, which I'll be, when the next one comes out, I'll be curious to see what it says. Additionally, rampant retail theft, costing U.S. retailers over $100 billion annually, has made it difficult for businesses to remain profitable. Yeah, close your stores in blue cities, folks. If you want to have a profitable business, do not do business with blue cities. An example of this is the recent wave of Lego thefts in Southern California, where thieves stole over $100,000 worth of merchandise from multiple stores. Shocking. Banks are also closing branches rapidly, with more than 400 branches shuttered so far in 2024. The shift towards online banking and the need to cut costs are primary reasons for these closures. California has been particularly affected, with 20 branch closures between April and June. The restaurant industry is experiencing a similar decline, termed the restaurant apocalypse. Red Lobster, for instance, closed 93 locations earlier this year and may shut down an additional 135 if it cannot negotiate lower rents. Well, I worked at Red Lobster back, 30 plus years ago before I went in the military, and I would not eat there. Really, if you want seafood, go to a real seafood restaurant. Red Lobster is just, everything is microwaved and, deep fried. Ugh. The combination of economic hardship, rising theft, and street violence has created an environment where businesses struggle to survive. Incidents of violence, such as a recent assault of a woman in Chicago, further exacerbate the situation. Increasing chaos and instability in the streets contribute to the overall decline in commercial activity and public safety. The current economic and social climate suggests that the situation will likely worsen before it improves, challenging the belief that normalcy can be restored soon. All right, so I'm glad I gave you all this positive news for the week going into the weekend, right? I know it feels like I'm just reading the world's on fire, everything's a mess, but all right. Well, that's everything I had for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All my contact information's there. I hope you have a wonderful weekend, and I shall talk to everyone next time. Adios.